With interest rate hike after interest rate hike after interest rate hike, will Australia go into a recession, and when will that happen, if it happens? In this video, I'll go through 4 charts. Number 1, how strong household balance sheets are for Australians. Number 2, how strong businesses are in Australia. Number 3, the strength of personal savings in the UK and the US to juxtapose, compare with Australia. And lastly, the timing of recessions versus stock market dips and what that tells us about property markets. Lots to cover. It's really fascinating data. Stick with me. My name's PK and I help people build passive income through property investing using the Property Investment Accelerator, using data without needing a $15,000 buys agent every single time. And this channel talks about property, it talks about the economy, and it talks about financial happiness. So if that's what you're interested in, stick around, smash the subscribe button, bell button, like button, all that good stuff. Let's go. This is the first chart, Australian household debt to disposable income. So your intuitive thought is that we have debt coming out of our ears, and the interest rate rises just mean that everyone is about to collapse. That's what the media is saying. That's the media is saying, oh, all these stories of people in Sydney, how they're living paycheck to paycheck. Look, nothing to take away from those stories, but here's the aggregate data. Gross income, gross debt to income, okay? So debt as a proportion of income at a gross level, ignoring people's assets like their savings accounts. It's at a record high. So you can see why the media is saying what it's saying. You can see why people are kind of scared, right? It's true. But look at net debt to income. Net debt factors in not just your liabilities like your loans, but your offset account balance, your redraw account balance, your liquid assets, and your savings account. Okay, when you incorporate that difference, that is huge. And that means that net debt to income is actually at a 20-year low. It's not been this low, since the early 2000s. So, completely different story depending on which data you look at, whether you look at the high-level data or more in-depth data. Same with net debt, less equities to income. Okay, so you can see that when you actually net out and really understand true data, the true debt position and the true asset position of household balance sheets, it's not that bad. People have high wages. Yes, debt is high, but they have an ability with cash buffers to repay that. And that is why interest rates are having to be bolstered so much by the Reserve Bank governor, because people are just floating in cash. I'm talking aggregates here. There's always exceptions. Now, you might be wondering, well, what about businesses? Okay, I understand that households are pretty okay. It's hard to believe, but the data is the data. What about businesses, PK? Interest rates are going up. Surely a recession is coming, right? With interest rates rising. Well, let's check it out. Australian or ASX 200 financials net debt to EBITDA before downturn. Now, before you turn this video off, let me just explain what that means in really plain language. So net debt is for companies, their net debt, their debt minus their assets. And EBITDA is earnings before interest, tax, depreciation, and amortization. In other words, it's how much money they're making, their income, their profits. All right. So what this is showing is that their net debt to profit ratio, so how much debt do they have versus how much profit they're making, right? Before the dot-com crash in year 2000, that ratio, debt was really high compared to businesses' income, 1.8 times. The 2008 financial crisis, GFC, it was 1.6 times, so it's still very high, right? COVID was much lower, and that's why the recession didn't really last that long, 1 or 2 months, okay? And the latest downturn, right now that we're experiencing, this net debt to EBITDA is very, very low. It's nowhere near comparable to previous recessionary periods or just before previous downturns. So what this is saying in conjunction with the other chart is that could a recession happen? There's always a likelihood of a recession, but it's very, very, very slim. But I don't want to espouse an artificially rosy figure because that is not the case in other parts of the world. You have to understand, it's not like the whole world goes into a recession and comes out of it at the same time, or even, during the same 1 or 2 years. Countries are different. And you can see here the British economy. This is household savings ratio, okay? So what this is saying is that, as COVID started, they got so many handouts from the government, much like a lot of places around the world, quantitative easing, fiscal policy, all that sort of good stuff. But that's coming right down. That's coming right down. So people in England and Great Britain are really, really starting to feel the pinch. Their savings ratios are right at their pre-COVID levels. All of that handout from the government has been absorbed by higher rate rises. And from this point onwards, any higher rate rises by the Bank of England will really start to cause pain. So I really do think that a recession is more likely to happen than not in Great Britain as opposed to Australia. And the same story exists for the US. When US coughs, everyone gets a bit of a tickly throat, so to speak, but it's not necessarily the case all the time. Once again, same personal savings rate or ratio as we saw for the UK. Same kind of trend. It was at record levels. Government gave out so much money under Trump, and now that savings has been eroded. It's been spent. We had record retail spending figures globally, and it's just been spent. And you can see now it's actually below what it was pre-COVID levels. What does this mean? It means that with every rate rise by the Fed, normal middle class America is really under the pinch. And so what that means is they have lower spending habits, consumer sentiment declines, therefore business sentiment declines, and the economy goes into a recession. So once again, unlike Australia, and look, I'm not trying to just kind of paint a rosy picture for Australia, but that's what the data showed us. The US, the UK, completely different economy. So when you hear stories about recessions overseas, that could be the case, but you have to take it with a grain of salt on how it impacts us back home here in Australia. And the last chart I want to take you through is stock returns during recessions. Why am I talking about the stock market? I know nothing about the stock market. That's not true. But what I'm trying to demonstrate here is that recessions are not bad for stock markets, and stock market sentiment often precedes real estate market sentiment. Okay, oftentimes the stock market, when it crashes, it's like maybe about 4 or 5 months before the real economy, and about 4 or 5 to 6 months before the real estate sector bottoms out. But the point here is, check it out. In history, you can zoom in on this and you can look at it yourself. When recessions start globally and when recessions end globally, stock market has generally performed well even through the recessionary period. So, there's a lot of people here on YouTube and other social platforms, maybe they're young and inexperienced, or they just don't have that education. And we think that recession automatically means huge stock market bust and automatically means real estate bust. This is a data, and it's showing that mostly, on average, stock markets go up even during recessions. Of course, there's anomalies, right? Like the GFC, there's no doubting that. But on average, they've gone up 1.3% and the median is 5.4%. The length of an average recession over the last, call it 100 years or 90 years is 11 months, and the median is 10 months. Why this is interesting is that markets bottom before the recession officially ends. So, a lot of people think, let me wait for that negative news cycle to finish. Let me wait till everyone starts making money again. Then I'm going to get into the stock market. Then I'm going to get into the property market. Look at the data. It's, once again, recession start dates, recession end dates, the length of a recession, 11 and 10 months respectively for average and median. But what happens is that market bottoms on average 5 months before the recession actually ends, okay? On average, almost every single time except for one recession, which was a dot-com bust, every single recession, the market has bottomed before the recession actually ends. So once again, to cap this up, to round it out, I don't think there is a very high probability of Australia Australia going into a deep recession that is of any consequence. Do I think other global economies will? Yes, absolutely. But even still, there's opportunity to make money, because you should not wait till the recession ends, even if it happens, before you get into respective markets. You should get there, according to this data, 5 months before the recession ends. Now, no one can really predict these things, but it's so interesting, right? Like everyone tries to spruik you, get into the market, get into the market, get into the market. But you have to understand how true economists, true financial analysts, true hedge funds and professional investors think, family funds think, not just what your colleague or friend says. It's often the best time to invest in a recession, because that is when the market has bottomed. But I don't think Australia will actually enter into a deep recession this time round, looking at the data that I've just shared with you. And guys, I've slipped into talking about the stock market. None of this is financial advice. This is just for education and entertainment purposes, but take the principles and apply it in your own individual circumstances, because I don't know them and you do. My name's PK, and I always say, the most important real estate is the 6 inches between your two ears. What do you think? Do you think Australia's going to have a recession? Comment yes in the comments or no in the comments. I'd love to hear what the whole community thinks. I'll leave links below if you want to level up in your knowledge, to my podcast on Spotify and Apple and Google Podcast. It's called Oz Property Mastery with PK, and also to my Facebook group, which is called the exact same thing. More than 20,000 people there. Hopefully this was valuable, guys. Data rocks. Catch you later. See ya.